Hi folks, welcome to this short video on Treasury shares. It would be a really good idea to have the question in front of you so that you can follow along and you're familiar with the data. You'll notice in the question that at the end of X8, the company had already provided you, or the authors had already provided you with some information on the company with respect to its shareholders' equity. You'll notice here in that small section of the equity section presented in the problem that there is a difference between the number of common shares that are issued and the number outstanding. That $150,000 difference is really the total number of shares being held in Treasury. So you'll notice that although we have 2.9 million common shares issued and in the hands of shareholders, which includes the corporation itself as a shareholder, we only have the shares outstanding with what I would call legitimate third-party shareholders, those outside of the corporation, at 2.75 million, because the other 150,000 are being held by the corporation as Treasury shares. And you'll remember from our original video, our initial Treasury share video, any shares that are being held in Treasury means that they're being held by the company, and the company will, because they're holding them in Treasury, hold them because they intend to reissue them. That's why they are Treasury shares. The intention is to reissue those shares that they're holding in Treasury or holding back at a future point. So now, with that opening equity section in mind to open X9, let's look at the X9 transactions. You'll notice here that the question told us that on February the 27th, we bought back or purchased 70,000 of those common shares and held them as treasury stock, and we bought them back from the investors at $6.50 a share. You remember the treasury share or treasury stock balance is a subset of the common shares, but it's also increasing its balance when we buy them back to hold them in treasury, and that represents a debit. So again, the treasury share account has a normal balance of debit, which means we increase it by debiting it. So again, to debit the treasury stock by the number of shares that we bought back from our investors times the price per share we paid, which is $6.50, gives us a debit to the treasury stock treasury stock or treasury share account of $455,000, and we paid $455,000 to buy those back from the investor. On March the 15th, we did the same thing. We bought back 32,000 shares, but notice what's different here that we didn't see in the initial handout is the fact that in this treasury share transaction, we bought back 32,000, but at a different price than we initially bought them back at which was $6.50. We're buying them back here in March at $5.50 a share. All that means is that it's costing us less to buy them back. So we're getting cash of $176,000, and we're going to be debiting we're paying cash of $176,000, and we're going to debit the treasury stock account to increase it by $176,000. But remember what we said. We said that whenever you're buying back shares to hold in treasury more than once during the year, but you're buying it back at a different price from your investors, you need to calculate the average cost of buying them back. Why? Because you're going to reissue them from Treasury and decrease the Treasury stock account the next time you reissue them at the average cost that you paid to buy them back from the investors. So what we're doing here now is we're calculating an average issue cost. So right here, what we're doing here is we're calculating, okay, the average issue cost. So in other words, the average cost that we're going to reduce our treasury share account by the next time we reissue the shares is going to be $5 a share. How did we get that? Well, the first thing we did is look at the fact that we started our treasury stock account at the end of X8 with $630,000 in it. We put in another $455,000 in it at this point in time, and then of course here on March the 15th we put in another $176,000 into our treasury stock account because we bought those shares back from investors. We have to divide the total dollars, which again are, I'm just going to slip down here, 1,261,000. So you might want to run a little T account here, eh? All I did was run a little T account to show you what the balance is at the date we're calculating our new average issue cost, right? And I'm going to divide it by the number of Treasury shares that represents. Up to this point, I had the original 150,000 in Treasury at the end of X8. In February, I bought back, or I repurchased 70,000 shares to hold them in Treasury, and then March the 15th I bought back an additional 32,000 to hold them in Treasury. These three amounts together, the number of Treasury shares are going to be 252,000. So in essence, $1,261,000 of shares being held in Treasury, plus the number of shares I'm holding, which is the total of these three numbers here, which is 252,000, is going to give me an average cost rounded of $5. So in essence, on average, it cost me $5 per share to buy the shares back to hold them in Treasury. Why do I need that $5? Because the next time I reissue the shares out of Treasury to legitimate shareholders, I'm going to remove them from the Treasury stock account at the average price of $5. In fact, what we said in class is that sometime, you would have also seen this concept when you were dealing with things like inventory in your prerequisite courses, right? So in other words, do you remember when you took inventory and you were having to calculate weighted averages with perpetual inventory systems? What did you do? You calculated every time you put something into inventory, you calculated the average cost of putting it into inventory, because you never knew when you were going to reissue inventory and sell it to customers, right? So you would have So you never know when you're going to have to reissue that inventory, but you want to make sure that you've got your average costs up to date. We're doing the exact same thing here, only we're doing it in the equity section with shares. So we need that $5 because unless there's another repurchase of shares, we're going to issue, or if we reissue the next lot of shares from Treasury to shareholders, we need to remove them from Treasury at $5 a share. And guess what? On April the 30th, that's exactly what we did. It says we reissued 50,000 of those 252,000 shares we hold in Treasury. We reissued 50,000 of them, and the shareholders who bought them from us only gave us $4.25 a share, but we paid on average $5 to buy them back from shareholders. So we're going to remove those 50,000 shares that we're reissuing to shareholders at the average cost that it cost us to buy them back from shareholders, which was $5. We calculated it here. So our credits for $2.50. Again, the shareholders are going to give us for each share they bought $4.25, and you can see we're a little light on the debit side. So what do we debit? Well, the fact of the matter is, you'll notice at the end of X8, we did have contributed capital on Treasury stock transactions for $66,800. So we have more than enough that we can draw down on to shore up the entry on the debit side to balance. So we're going to use up $37,500 of that $66,800 of contributed capital on the Treasury stock transactions that opened X8, X9. So we can use that. Notice we're not debiting retained earnings here. We don't need to. Why don't we need to? Because we have sufficient contributed capital from Treasury stock transactions. If we didn't have any contributed capital on Treasury stock transactions to open the period, or if we didn't have enough, then we would debit what we need to balance the entry to retained earnings. But so far, we're good. Now what happens on May the 16th? Well, on May the 16th, again now, we purchased 27,000 common shares as Treasury stock. So we bought back 27,000 shares and held them in Treasury, and it cost us $6.05 to do it. So now that we've got a different cost here, after we record this entry for May the 16th, we're now going to have to recalculate an average cost that it cost us to buy them back. So what we're doing here on the 16th of May is what we would normally do. We're going to debit the Treasury stock account to increase it by the number of shares we bought back to hold in Treasury times what it cost us to buy them back from the investors, which is $6.05, So we're going to debit the treasury stock account for $163.5 and credit cash for the amount that it cost us to buy them back, which is $163.5. Now, as I said earlier, the next thing we have to do is recalculate the average cost, what it cost us on average to buy them back, because you never know the next time you're going to have to, or you decided to reissue them, okay, to legitimate shareholders outside of the corporation, and at that time you'd have to remove them from your treasury share account at the average cost that it cost you to buy them back. So in this case, we're going to take our balance that we had in our T account the last time we calculated an average cost, include the fact that on April the 30th we issued $250,000 in treasury stock, right? That was when we reissued stock from treasury at the average issue cost of $5, $250,000, right? We credited treasury shares and we were reissuing them, and now we're buying them back on May the 16th. So we're putting them back into treasury. So now our balance to help us calculate our new average price is $1,174,350. But at that time, how many shares do we have in treasury? Well, again, we're going to go down here and we're going to look at everything we've done up to May the 16th. And you'll notice you started with 150,000 shares. You put 70,000 and 32,000 in treasury up to the end of March. Then don't forget you reissued some shares, 50,000 from treasury, so you took them out. But again, on May the 16th, you bought 27,000 back from the shareholders and put them back into treasury. So by the time you get to the end of May the 16th, including the transaction of that day, you are going to be averaging out this $1,174,350 by dividing it by the total number of treasury shares that you're holding now, which is 229,000 if you add these five numbers. So therefore, if we go back up here, that's all we're doing here is calculating a new average price, and we're going to get $5.13 rounded. So now the next time we issue shares out of treasury to give them to legitimate shareholders, we are going to be crediting the treasury stock account for $5.13 times each share that we issue or reissue to shareholders. And at that time, on November the 26th, what do we see? We see that we're reissuing 134,000 treasury shares, so we'll take them out of treasury at the average cost of $5.13 a share. So we're going to be crediting the treasury share account by $687,420. At the time we did that, we took in cash for those 134,000 shares, multiplied by the number of the amount that the shareholders gave us, which was $4 a share. So we're going to debit cash for $5.36. So what do we need to do to balance the entry? Well, again, we still have a little bit in our contributed capital account in the for treasury shares. We had, don't forget, 66,800. We drew down on April the 30th by 37,000. We see that here. So we're going to need all of the balance, the entire balance, to help us balance the debit side. And again, we need to balance on the debit side because it's cost us $5.13 on average to buy them back, but shareholders here only gave us $4. So we've got to balance the entry on the debit side by using up what we have in treasury stock, which isn't enough. So we need to go to our good buddy retained earnings to help us shore up the entry after we've drawn down on contributed capital in the treasury stock account so that we can balance the entry. So now what we need to do, requirement 2 asks us to go ahead and calculate what the balances in each of the accounts are in the equity section. So now in requirement 2, what we need to do is calculate the values that are in each of the accounts in the equity section. Well, notice here, the first thing you got to notice is that the common share account is still sitting with shares issued of 2.9 million. That didn't change from the opening. Why? Because we never debited or credited common shares in X9, so it didn't change. We debited and credited the subset of the common share account, which was the treasury shares. Remember we said in our opening video, which was based on our handout, that we have to make sure that we segregate all that subset of shares that we're buying back, holding in treasury, and then reissuing from treasury, all to the Treasury share account. So what do we know? We know that we've still got 2.9 million are issued, but outstanding are only the shares that are in the hands of legitimate shareholders. So it excludes any shares that we're holding in Treasury. So how did I get that 2.805 million? Well, guess what? If I'm running my T account, I know by the time I reissued these shares from Treasury to legitimate shareholders, if I total up all the number of Treasury shares that I put in Treasury with the plus signs and I took out of Treasury to reissue to shareholders, I've only got 95,000 left in Treasury. So all I do here to get the 2.805 million, that's my 2.9 million minus the 95,000 that I'm holding in Treasury. So I still only have in my common share account exactly what I ended X8 at, which is 10,585,000, because everything has been going to this subset account, Treasury stock, which has its own balance. 95,000 common shares still sitting in Treasury, right? And what's the ending balance in the Treasury stock account? I can very easily calculate it dealing with my T account. So if I go in there, I had 1,174,350 at the end after I did my May 16th transaction. And when I reissued Treasury shares, right, on November the 26th, right, I credited my Treasury share account for 687,420. Again, you can see that in the entry right over here. So that's going to give me an ending balance of 486,930. Right? So that's what I've got here. And notice again, the Treasury stock account has a net debit balance because it's a contra account to your common share equity account. So it counterbalances that. And my contributed capital on Treasury stock transactions, I don't have a balance there. Remember, I used it all up here. I had 66.8. I used up 37.5 on April the 30th. Right when I reissued Treasury stock, and again on November the 26th, guess what? I used the rest of it up because I needed it to balance the entry, so there's nothing in there. But what's in my last equity account, retained earnings? Well, the question told you at the end of X8 you had 7,420,000 in your retained earnings account, but how much did you debit or adjust retained earnings by for Treasury share transactions? Well, what did you do? The only time you needed to adjust, you'll notice in none of these transactions here did you touch retained earnings until November 26th came around, because it cost you were reissuing the Treasury stock out of Treasury shares at the average cost it cost you to buy them back, which was $5.13, but shareholders only gave you $4. So you needed to borrow a little bit from your retained earnings or draw down on your retained earnings by $122,120 to balance the entry. So that's only going to leave you with $7,297,880 left in your retained earnings account. So this concludes our short video on Treasury share transactions. So I hope you found it helpful. Enjoy your day.